All right, good morning, everybody. One of the things that we saw yesterday was a false CPI report that had come out. The market started reacting to it in the late afternoon. It was an exaggeratedly bad CPI number, and the market reacted. If today's CPI number is as bad as that fake one was yesterday, you kind of have an idea of the reaction you're going to see in the market today. All right, so what we do in the morning when we're working on these morning briefings, we want to see what happened around the world while we were out and what's on the agenda for today. I like Finance Juice for this, but it's not the only place out there, right? But you go to Finance Juice, it's free. You don't have to pay for anything. If you make your own account, you can sort of sort out the news that shows up on this thing. So it's worth making a free account just to be able to do that. It's got a lot of extraneous kind of junky news that it's nice to filter out. Once you do filter that out, you got a really nice list of what's going on, including the European market wrap. Now, every single market that closes, it'll do a wrap for the US market and then a wrap for the Asian markets. And then even though Europe isn't done yet, it knows that we're coming in on the day, so it gives us an early wrap. A lot of times you'll see what sectors were moving, what was the carryover from our market into Asia, from Asia over into Europe, and then from that, what our expectation is of what is going on in Europe that might carry over here. If technology is hot, or real estate, or energy, whatever it is, it often carries over. So it's worth checking out what happened last night. On the same idea, if there is something really large going on in the world, the example that I like to use is when that ship got stuck in the canal. If there's a really big world event going on that is going to have lasting ramifications, you kind of want to know about it as soon as possible. Having said that, though, most of the time we don't have something like that, right? We take a look, we just kind of look around, but don't invent something that isn't there. If there's nothing really drastic or extreme going on, then that's it, move on. It is CPI day. It's going to come out at 8:30. It is expected to be one of the most impactful events for July, right? There was 6 events, high-ranking events as we started the month, and now we're down to 5. We get this one out of the way, we'll have 4 left for the month, but this is one of the biggest out of those 6. We still have a pretty drastic yield curve inversion. We are in backwardation. Yesterday we did a live stream in the Discord. We used options Omega and was running some back tests on in the money long verticals using like a 60 or even higher than a 60. It's worth checking out. Option Omega now has share links, so we were actually able to not only build the back test, run the back test, but now we can share the links for the back test, which is pretty cool. They just got that started yesterday. So if you're running your own Option Omega account and you want to import the share link, it's on the video in the description. All right, 8:30, 10 o'clock, 10:30, and 1 o'clock. That 30-year bond auction is going to be very impactful. Don't let it slip past. You know, we were all waiting yesterday on that 10-year. 1 o'clock came and went, and there really wasn't much of an impact from it. But you never know, right? And that's kind of the whole point. You never know what you're going to get. You want to be prepared for it. During my lunchtime analysis, I'd actually given a very clear description of what a bullish move would look like and what a bearish move would look like. And after 1 o'clock, we really didn't get any of those. And yet when the fake CPI numbers came out, we did, right? We hit every one of the benchmarks, every one of the signals that I had wrote that we would want to look for, right? So even though the original anticipated volatility didn't happen where we were expecting it to happen, it still happened yesterday. and we were already prepared for it because we had already reviewed and discussed what those signals would look like. It's hard to try to trust a move when it first starts to kick off, because we don't quite know if, is it just going to bounce and create a double bottom? What's it going to do? But when you're able to validate it through the other signals, got a lot more conviction in the move. All right, we're looking at a daily chart. This is year to date. It won't be very much longer before I swap this off of year to date and start just using 6 month. We will have gone too far on the year. But right now, the cyan line is the anchored VWAP. We're underneath it. As long as we're underneath the anchored VWAP, we're in a negative market, a weak market. Kind of use whatever phrase you want to use there. The white line is linear regression, uses dot plot statistics. It counts every single candle, so the candles matter. I keep getting questions from this, even from experienced traders that should know better. It's a linear regression. If you don't grasp that logic, take the time to go learn what that is, or listen to what I keep telling you again and again. This thing will count how many candles you are looking at. So if you're on a daily chart and it's year to date, every day it's going to change. If you're on a year to date, a full year, 12 month, it's going to look completely different. Yeah, it's still a daily chart, but the number of candles are now different, right? And if we stay on a daily chart and we add even one more year to this, it looks completely different. So it's not just because you're on a daily chart. It's how many days is this thing looking at? One thing that you could do to remain consistent is always look at it on the same time frame all the time, always. Don't change your time frame. Choose 1 year, 6 month. I don't care. It doesn't matter which one you choose. There's not a right one. There's not a wrong one. There's not a better one. I keep getting those questions. There's just the one that you want. And once you pick it, stick with it. Try it for a few months. If you don't like it, at that point, you'll have a really informed opinion about how many more days you want to add or take away. So with the linear regression line in place, it really starts to highlight where these swing highs and these swing lows are. And when we fail to set a new swing high, or if we get a matching swing high, because here we stalled, we had a muted swing low, and another attempt or another run towards a swing high, failed to get it again. And what we're ending up here is higher lows, lower highs, and we're compressing more and more and more. This thing's getting ready to make one heck of a move. The only thing is, it doesn't promise what direction it's going to make that move. But the markets are like a thing of nature. And in nature, you cannot compress energy endlessly. You have to let some of that energy out. That's why dams let water out, right? You can't just contain something in nature. You have to have a little bit of a release valve, or sooner or later it's going to pop. Well, this thing is winding up building more and more and more energy. It's going to pop. All right, so for today, expectations, we can only do one of three things: stay range bound, break out of the bottom, break out of the top. The range case is the base case right now. It is a very wide range from 38.76, we'll call it 77, all the way down to 38.04. A very large range. And we're not quite in the middle, but we're pretty close to being in the middle, right? And if you're in the middle of the court, you make a significant run in either direction, after all of that work, may still not have made it to the edge yet, right? Even from the peak of our own Globex today to the high of yesterday, you're looking at a 1% move. Same thing in the other direction, near a 1% move, not quite 1%. So we would have to make nearly a 1% move just to get out of this box. And the current ADR is 2.4. So we have the capacity to make a 1% move plus some with no problem at all. But even in an exaggerated move, say like the move we had yesterday with that nice deep fall, that liquidation break, we really didn't extend too far beyond the Globex low, right? When it was all said and done. So the range case is the base case. It is the most likely scenario. But these CPI numbers today goes to the heart of the inflation measurement that they've been working on. So there's very likely going to be a strong reaction to the numbers. On a day like this, the market makers know that there's likely to be a strong reaction. They put a market maker move on there. We have an additional 0.5% that the market could move today, and it wouldn't even be considered an outsized move. So now we would take that 2.4 and we would add this 53 to it. And you're looking at what, 2.9? That's a pretty significant move on the day, but that would still be normal. So let's just give it a little and call that a 3% move. A 3% move today would be normal. An extreme move today would be 4.5%, and it's 4.5% from the close. So if you want to measure your lines, the yellow line up here is the full ADR. A 4% move, 4.5 is what we're looking for. You're looking at the 400 strike. So way up here, nice round number. We get to 4,000. That is our extreme measure for today. Take the same thing in the other direction. You're looking at 36.55. I think if we get that close, we're very likely to go to 36.50. But we'll use 55. So that would be a measured move for both sides. If we get extreme to the upside, extreme to the downside, which now gives us 3 different benchmarks: half the ADR, a full ADR, and then ADR plus market maker move multiplied by another 50%. And I've had people say, isn't that a bit extreme? Aren't you kind of reaching? Yep, I am reaching. And yet we've made those moves before on anticipated big events like this. Now, one thing worth remembering on a day like this, everybody's expecting the big move. And just like yesterday with the 10-year, the 1 o'clock auction, everybody was waiting for a big move to happen. No big move happened. It didn't catch anybody by surprise. Nobody was caught off sides. There wasn't a big move. Nobody was squeezed. There could be a slight argument that today could do the same, which is why the base case is still the most likely case, is that we're just going to maintain our range. We want to plan for an oh my gosh kind of move, but that's the least likely scenario. Work through the pivot points, even within our own range on a day like this. If we're looking at an upside move just to retest these highs, we'd have to get through our own Globex. We would have to challenge the open of yesterday, then the Globex high of yesterday, then a half an ADR, and then yesterday's highest point. So as you can see, we've been able to line up multiple pivots to an upside move that would just get us back to the top of the range, but still benchmarks along that way. So 38.39, 38.51, 38.65, 38.76, 38.70 if you want to add half the ADR. These benchmarks, what we would focus on for every new location that we get to, right? We get to one benchmark, stop, evaluate where are we headed next, where's the next benchmark, what's the likelihood we're going to continue to move in that direction. We don't have to try to guess or assume that price is going to bounce when it gets to these numbers. When it gets to these levels, this is a place where we anticipate a reaction in the market, that it could pause, stall, turn away there to get deflected. So we don't have to guess that it's going to do a particular thing. We can let it get there and let it make the reaction and then trade the reaction off of that. So I often get asked, do you think it's going to bounce there? No, I don't. I don't think it's going to do anything there other than give me a reaction. So don't try to presume to know what it's going to do. Don't guess that it's going to bounce there. We have the open from Sunday night. We have the close from Friday. We have Friday's high. We have Thursday's high. And as you can see, each one of those provides another benchmark, right? These are all universal pivot points. If we were on the 5-minute chart, we would call this mapping out the 5x5. Take a 5-day, 5-minute chart, go back and mark out all the open, high, low, close. And you provide yourself with all these pivot points. Now, all of those are to the upside. So let's back up and game the system and look at it from an opposite point of view. What if we don't go up, but instead we go down? We got the Globex open at 6 o'clock. There's the 4 o'clock close, which is considerably off from the 6 o'clock open. So a nice gap there between where we closed at 4. Let's see if that lines up. Take it out to the daily. Here's the open of the, maybe the open of the Globex or the close of yesterday. Take it back in and look. Yeah, that'll work. And our own Globex low of today, which has been tested already. This snap isn't working this morning. So for a downside move, 38.18. Let's back up. 38.23, 38.18, 38.12, and then 38.04. There is a cog line down there at 38.11, and I would be much more interested in that cog line than I would be the 4 o'clock close. So they're close enough together. I would just lump them together. And if we break below 3,800, we really have to widen our charts out and our scope to try to find something more than that. We do have this angled line. If we come back out to the daily for a moment, we have this angled support line. And this always gets distorted. It really doesn't matter which program you use or which application you use. If you draw something like this on a daily chart, as soon as I go into the intraday, it's going to be off, right? It's not quite where we would want it to be. The reason for that, Thinkorswim wants to land you in the middle of the candle. Well, if it's a daily candle, then it'll try to take the time frame in half. If it's a 2-minute candle and you snap to the middle of the candle, then you have 1 minute and 1 minute. right? Because you took half of a 2-minute candle. So 12-hour candle, 6 hours on each side, right? Makes perfect sense. So on the daily, it looks fine. Like, oh, I just snapped from this wick to that wick. And then when you start getting into the smaller time frames, you look at it and your line just looks wrong. It's off, not quite right. Don't stress on it. It's not an exact science. Price doesn't see your line, right? It's more of a visual. There is an angled line of support underneath there. If we break 3,800, there's an expectation that we're going to interact with it. We're looking at the volume profile here, 10 days, 30 minutes, and we are in the middle of the box, very close to the point of control. His point of control is where the greatest amount of volume is. For that upside break that we were talking about, there's a significant level of resistant volume, 3860. So if we get into that area, we've got to struggle through that volume. But here's the thing with the CPI numbers, if we get a very extreme moves will punch right through this like it isn't even there, right? So if we grind up to that level and find that resistance, that would be one thing. At 8:30, when the numbers come out and we see price just running extreme to one side or the other, these levels won't matter even a little bit. We've seen that yesterday when the false CPI came out and we had those extreme moves to the downside. It punched through all the levels like it wasn't even there. 3884 is the value area high. 3776 is the value area low. It's a little more than 100 points. So a nice wide range yet again. It's a little beyond the ADR, which is fine. We have some volume support tied up along that value area low, by the way. So when we're in the box, usually the expectation or the phrase is if we're at the low, we expect to go to the highs. And if we're at the highs, we expect to go to the lows. But we're in the middle. And when you're in the middle, you can go back up to the highs or back up to the lows. And then if it's an extreme enough day, we can actually go to both sides. We go all the way to the bottom and then go all the way to the top or vice versa. So literally, we're just sitting in the middle of the court ready to make a move. Now, one thing that's important about that concept or phrase of sitting in the middle of the court is we have the capacity right now to make a very large move, and it wouldn't even be considered extreme. Because we're not overbought, we're not oversold. Like this thing is just primed, ready to go. All right, so we got an untouched point of control over our heads, 86.56 and 39.05. As I've mentioned before, you can carry forward the value area high and low, especially if they're untouched value areas. I generally don't carry them forward because I've got enough pivots. I don't need those. But if you go and study a volume profile, that's what they're going to teach you to do is carry them forward. And we're talking about distance from moving average or not being overbought or not being oversold. Here we're looking at the 10-day and how far away from the 10-day the market is. This is an indicator that I built quite a while back to help me kind of gauge each market's reaction to getting too far away from its own 10-period moving average. Think of the 10 like Earth, or say an astronaut bouncing around on the moon. Sure, they're light, they're bouncing around, but there's still enough gravity to keep bringing them back down again. That's very similar to the way the market reacts with its 10-period moving average. It really wants to keep coming back to it. So it will expand beyond it to a point, but that point only carries it so far. And each market has that distance differently. So for an example, the ES may like to stay within a 4% range of the 10 moving average, whereas the NASDAQ might like, say, a 6% range. Well, what this indicator is showing us is, sure, we're below the 10, just barely, not even a 0.5%, but we're right there. And we have the capacity to move 6% away from the 10, or 3.5% away from the 10, and it wouldn't be extreme at all. So when we think about how far this market could move after today's data, it has the capacity to be a pretty significant move. One of the things that got my attention yesterday was that the VIX woke up. Now, I've been kind of trashing this thing on a day-to-day basis. It's been worthless. It's a piece of junk. All year, it hasn't been any value or use to us whatsoever. So when it actually starts to wake up and move around, it should get your attention, right? Whatever was going on yesterday in that liquidation break, which we know now was a false CPI report. But at the time, we didn't know that, right? We just seen this market start to break support, break through VWAP, and really start picking up speed. And the VIX woke up. So that should have been one of your confirming pieces. Like, is this move going to be sustainable? Is it going to continue to go through the day? And of course, we never know 100% sure. Right? We've seen reactions when the Russian president, when the early part of the war, when he had come in and made some unfounded statements, and the market would react, and then 30 minutes later, it wiped it all back out again. So we never know for sure that a move like this is going to stick through the day. But seeing that confirming signal in the VIX yesterday should have been one more notch that said, yep, this thing is sustaining itself. Bitcoin back above VWAP. I keep seeing calls for Bitcoin to 10K. Now, you know, it's not going to be a straight line. Obviously, it's not going to go straight to 10, but each benchmark, each call out has been hit, you know, from when we were at 50 to 40, when 40 to 30, and 30 to 20, and now 20 to 10. We look at the 10-year yesterday and that 1 o'clock auction. I mean, there's really just nothing there, you know, a little bit of reaction right at 1 o'clock, and that was it. And that reaction wasn't shared in the rest of the market. A little bit of volatility was all we got at 1 o'clock. And the only thing that I could say about it is at least everybody was warned to watch out at 1 o'clock. And so that little bit of volatility there, that 15-point move in the ES, shouldn't have caught anybody off by surprise. There was also a pretty rough move in oil yesterday. I mean, it was drastic. Seems like we may have found a temporary bottom at around 94. I don't think we're done with that bottom. We're very likely going to retest it. But my expectations is higher oil, you know, on the year, not maybe necessarily for this week. But I don't think we're done with high prices on energy. And, you know, while we may get a double bottom there on that 94 in oil, we may even settle off a little bit lower. A lot of analysts out there are fighting about this. One big name firm is saying oil back to 60. And another big name firm is saying oil to 360. Can imagine what that would look like against the market, right? And then apparently Russia's playing games with the gas pipelines, turning them on and off, and threatening to leave them off. That's going to have all kinds of ramifications, and it's causing a lot of angst in the market. So it's definitely one thing to keep our eyes on as well. Don't forget, you get the 30-year bonds today. It's my day to stream at the Bullish Bears in the futures room, and we had a request to talk about bonds. So we're going to be talking about trading bonds in the futures room today. And double bottom in the Dixie, in the dollar index. The long-term target for the dollar, I think, is around 120. But again, that won't be a straight line. And I think we're more likely to go back to, say, 100 first before we go to 120. But still expected to see 120 with either by the end of this year or within the next 12 months. All right, we still got a lot of compression in Tesla. We were getting these consistently higher lows and lower highs. The other day we did set a higher high, but not by very much. I mean, you know, you almost have to have a stretch of imagination to consider that a good higher high. But we've still got a clearly defined range between, say, below 8 and above 6, or maybe 620 if you want to tighten that up a little bit. And right now we're in the middle of the range. So, you know, today might not be a bad idea to consider starting to build, say, either a strangle, a straddle, or perhaps an iron condor. Maybe put some butterflies on each end of this. The skewed butterfly comes to mind as well, or a broken wing. This won't last forever, right? And the longer we're sideways like this, the more people are going to see it. It's going to self-fulfilling. It's going to break eventually. But might as well get it while the getting is good. There's no, the room is big enough to run it from the middle to the high or from the middle to the low. But when you try to attempt a directional trade from the middle of the range, there's nothing to lean on. So something to consider, right? Trying to go long from here or trying to go short from here, you're going to want to find something better than the daily. For today, we will be looking for an inside day breakout, the continuation of this last swing high. $695 institutional pivot point, perhaps even 690. So we're looking for a break below that, and we're just looking for a continuation back down to around that 650 level, right? For more of a day trade point of view. Notice how wound up and tight we are here. This is very likely going to also respond to the rest of the market's response on the CPI this morning, but kind of game out. What would a super bullish move in Tesla look like today? Because if the market does turn bullish, it's going to go across all the MOTs, right? All the MOTs. So for Tesla, which has an ADR right now of 5.5, what would a 5.5% move look like from the close today? That's what you want to kind of game out, because these options are not cheap. If you can, say, get some cheaper ones by using some out of the money, then you've got to try to figure out how far out of the money you're going to go. Something like a 5% seems like a good idea. Apple's getting bid up in the pre-market already. Of course, we know that this won't stick. If the CPI is negative, this thing is going down, just like everything else is going to go down. It's had some mixed news in the last few days. Some good, some bad. When it comes to bad news, Google has put on a hiring freeze, I think, or there was some hiring news on Google, which kind of sets the tone for everybody else, because it's been able to avoid a lot of the negative ramifications of all of these rising costs. But now, if it's also getting to the point where it's got to adjust its hiring practices, then that says a lot. So for Apple, we are looking at an R2G carryover. The 11th was the red day. Yesterday was no follow through. Kind of see that rejection off of the 147.5. So we really want to get a nice clean range. All of this is yesterday's range from 148.5 down to 143.5. It's a $5 move. The way to kind of game this out to me is if we can get to the edge due to the CPI on either side, either the edge to the upside, the edge to the downside. If we can get that before 9:30, before the open, then when we come into the open, we break through the edge on either direction and we start to make that extreme move to carry the push beyond the range. Otherwise, we're looking at a base case scenario of us just maintaining inside of yesterday's price action. And when we look at this, that'd be multiple days in a row that we've just been really holding inside of this large range where we got above the 50. We're resting on the 50. We've managed to stay above it and use it as a little bit of support. But today's going to very likely be, it's going to settle this one way or the other. From this low down here, we are focused on the swing high, the swing low. We'd be looking for a higher low somewhere in here. And when you put linear regression on it, you realize once we get towards the edges, you got to ask the what's more likely scenario, right? We've already came off of the swing low. We made it to the swing high. What's more likely from here? That we continue to swing even higher, break above 152, this pivot back here, and then we challenge the year-to-date VWAP, or that we stay sideways, perhaps pull back a little bit into that 140 area and retest the mean. So when it comes to the what more likely scenarios, that linear regression line really helps kind of clean it up. So we talked about Google yesterday. The split is getting closer and closer. It really didn't get the excitement of a split that we would have expected. We got a sideways 50, which doesn't really provide any real comfort or anticipation or expectation of a bounce. These ranges are nice and wide, 2100 to 2400, kind of working our way back down. Yesterday's range was very narrow. So with the CPI today, we're going to be focused on, if it's positive, getting back inside the box and then working on 2340 or 2350 to get a topside breakout. Should this continue to carry the negativity from the CPI report, if it happens to be bad and we're still heading to the downside, then target would be 22 and then 21, right? 2150, I don't see much there except perhaps a little speed bump. Microsoft broke angled support yesterday. It gives us like this little micro double bottom. And if we continue with this negativity, then the target's going to be 242.5. Again, I think it's going to be directly related to the CPI numbers today. So if the CPI numbers are negative, then that will be what the target is. Now, they always talk about how a market takes the stairs to go up and jumps out the window to go down. That was a real big move yesterday. We've now got this massive candle. It's going to take days, very likely, to even just try to climb back up to the top of that candle. So if the CPI numbers are not negative today, and we manage to open and stay within this candle's low, then it's very likely that this low and this candle's high is going to be our range for at least a week, unless the CPI, of course, is really bad or really good and we start to make some extreme moves. That's not too bad of a range if you're thinking about an iron condor or even a strangle or a straddle. The cost of these options right now may be more than a strangle or a straddle is worth, right? Because the cost of that is going to define where your break evens are. Your break evens might be too far away. $256 right now is the line in the sand. We need to get back above it and start proving that it is our new support. Lots of compression in Amazon too. There was a head and shoulders at the low of this range. And like I had pointed out before, a head and shoulders is something that you want to find at the top of the range, not something that you want to find at the bottom of the range. I had a lot of people asking about this head and shoulders. Was it a head and shoulders? Were they really seeing it? Does it count? It is a head and shoulders, but it was in the wrong location. Now, it doesn't mean that we couldn't get the follow through and that we wouldn't want to measure it and see what our downward projections would be. But we did have to approach it from the idea that it very likely wasn't going to be a head and shoulders with a follow through where we would, draw a line on the neckline and measure head to neck and then plot our downside target. And that's because the head and shoulders isn't supposed to be at the bottom of the range like that. This is a reversal pattern. It's not a continuation pattern. And finding it at the lows and then expecting price to move beyond this even lower would suggest that it is continuing. A head and shoulders is not a continuation pattern. It's a reversal pattern. So I had a lot of people get stuck on this. It is a valid head and shoulders. It is. But we got to learn when to recognize that a pattern doesn't fit in a particular location that we find it in and say, sure, I'm willing to measure it. I'm willing to entertain the idea that we could move in that direction, but it won't be my first argument. It won't be my base case. Sure enough, we bounced when we got back down to those lows, giving us like multiple retests along this bottom. And we did not get the continuation lower. Now it no longer is a head and shoulders. All right, so the head and shoulders is done. That's off the map. We do have compression, however. So lower highs, equal lows. The current low is not marked yet because we have to come off of that low before we can mark this as a higher low. So we can't mark it as a higher low yet. The low isn't done. That gives us lows from here and lows from here, equal lows, lower highs. Again, a market wound up and winding up with more and more energy, getting ready to make a big move. Meta or Facebook, very tight range. If we start with the gap at 176, bring it down to say 155. There's the trash. There's the range that we've been dealing with. And we're basically very close to the middle of that right now. So again, that argument of, well, I want to get a trade and I want some edge in my favor. You try to trade this, you're starting in the middle of the range. That doesn't mean you can't trade it, but you're going to have to go to something beyond the daily to find any kind of edge. Maybe an inside day breakout. We are primed now for an IX10, multiple days in a row inside of this starting candle at 7-11. So should we break below 161.75, then we're going to target the low of this very large candle, 158.43, or at least the open of that candle. 158, I just used the round number, 158. The top side move can also be argued. So if we break above yesterday's highest point or yesterday's open, then we'll have a red to green with an IX10. And our target would be 167.5. If we get above that, start marking the pivots from these 4 candles here, including the very large one at 168.25. The open from 7-7, which was 169.5. I think we'd be stretching the edges of how far we could move in a day on Facebook at that point. I don't see it getting above 170 in a day. Although, you know, I mean, it's got a 4% ADR and a 2% market maker move today. So, you know, it has the capacity to do it. There's been a lot of talk about the chips. The chip companies are the short of the year. Everybody's shorting the chips and there's still a lot of meat on the bones. So, you know, you're looking for swings, then shorts in the chip companies is kind of the trade du jour right now. So what I got, everybody. Be careful, be safe. And I will see you guys in the futures room.